I'm now going to give, we've got another panel coming up about early stage investments after this, but between the two, I'm going to segue in a data sandwich. I'm going to ping some data about what's been going on in the investment world and offer some of my own analysis, I guess. I've got to start with a disclaimer, as I always like to do. If this is working, is this working? It's not working. There we go. Where do I need to point it? Okay. Well, I'll start with a disclaimer. Hopefully it'll come up in a minute. Oh, there we go. There's my disclaimer. I'm not a professional investor. I've been in the games industry for a long time. I do know a lot of investors. I know a lot of games industry professionals. I've been a journalist, a media owner, event owner for 25 years. I do also do some small-scale investing. I've got investments in 10 companies at a very low level, mainly in the game space. But I'm not professional. I don't look at multi-million, billion deals for a day job. But I do speak to a lot of experts, and so the data I've pulled together is from other people who are experts, so it's not just me making it up. So let's as always, it's always good to start where we are and where we've come from. So this is one if you saw my trends talk earlier, you've seen this graph before, but I don't apologize for saying it again, because I think it should be the most motivational thing for you if you're in the games industry. That is where we started. That is where we are now. Up the top there, we have grown for 25 years. Not only have we grown for 25 years, we have evolved through all these different technologies. We talked about VR, the holodeck, we talked about AI. You can see historically how we've gone from the arcades through consoles and PC and how that's evolved. Handheld consoles, mobile, obviously the big change. We've grown for 25 years. Last year, as I said yesterday, and has been probably said elsewhere, we had our first slight down year. I'll talk a little bit about that in a minute, but overall, we're down 4% year on year, the first time in 25 years. But overall, our trend, if you look, check out the COVID years where there's a massive leap up, the trend is still upwards, and we are still going very well. This is another graph I always like to show, which just, again, shows the different technologies. And it shows also why people invest and why you should get excited. If you look at, if you look at how kind of arcades sort of disappeared and how various waves of console have come. If you look at the PC growth, handhelds come and gone. But if you imagine you were there, those early days of mobile, look at that incredible growth you could have been part of. Now, what's going to be the next one of those? I don't know. You've got to put investment to do that. But it does illustrate why so much money wants to get into the games industry, right? So there we go. That's what I said. That's the games market now. We're a $184 billion market. That's fine. Oh, okay, slightly graphical thing there, but never mind. The thing to be aware of is where we are now is in slight market turbulence. We had obviously the COVID period and then the coming out of COVID period. We've had the war, the resulting inflation. A lot's been going on in the last year. And it's led to every part of the economy being in sort of turbulence, and the games industry is not immune from that. The games market, as I say, was down in the last few quarters last year. You can see some of these tables here. And some segments are still suffering now. Basically, also what happened is money has become a bit tight, as we heard about in the last panel. We heard that investment money is kind of tightened up a little bit. So combine that with slightly less revenue, tighter investments, game studios are taking less risk. They're de-risking. They're doing less projects, and they're laying people off. And that creates this kind of vicious circle. Everybody panics a little bit. But that's turbulence. But don't panic. The general feeling is, amongst most analysts, is that normal service will be resumed. That there's going to be a bumpy period. We're still going to have plenty of bumps in the road. But most analysts are predicting growth this year, certainly growth next. So everyone's really thinking, that knows what they're talking about, much more than me, that we're back on an upward track. It might be slightly different. What makes the money might change slightly. There might be some variations on that. But mobile is the thing I've known most about. The app installs were up again in Q1. The revenues are starting to go up. That's the wrong pitch from Data AI, but the later version of that shows that the revenues of the spends have gone up again. And if you look forward, people are even more bullish. Analysts' job is to be bullish, right? But there are predictions from Newsy to 23 billion by 2024. Who is it that predicts Mordor predicted 307 billion by 2027, and Global Data have us all the way up to $400 billion industries. Yesterday, I think we had a panel where people were estimating that we could be worth 800 billion in 10 years. And Paul, obviously, was just on the panel before, and if you saw him, he's talking about $1 trillion, multi-trillion dollar market. The opportunity is vast. We will grow. And talking of general growth, again, I need to always reiterate, this isn't just a global thing. This isn't things going on in America or China or whatever. This is happening right here. You are in the fastest growing region in the games market as of last year. This is not me saying this. This is the official market data from Yuzu. It grew when everybody else was wobbling a little bit. MENA's grown. It's grown 6.6% up, and it's grown in terms of its player base as well, up 8%. So let's look at some investment history here. This is a little couple of charts of the investment market. I've taken this from a company called DDM, who credited just for me, which is why I haven't got the latest one, so it only goes up to Q3, but it gives you the indication. You can see, as was discussed in the previous panel, this is the M&A, this is the big acquisitions on the left here. You can see that this has been an unprecedented time. You can see blips in 2006 and 2008 with some pretty big deals there. Historically, you can sort of map those on to things like King being bought or Supercell being bought or something like that. But these last 2 years have been kind of crazy. And also, this is the investment stuff. This is where people put money into companies. That's been crazy as well. And these figures don't actually include the Activision deal, which some of the others do. So as we were saying about M&A, 2021, that market kind of exploded. The previous year had been 33 billion. Suddenly 2021, it's 85 billion worth of M&A activity. And then 2022 just got even crazier. In Q1 alone, albeit that's including the Microsoft deal, which still hasn't been done yet, but in terms of the announced deals or the planned deals, the market went absolutely crazy. It already beat, they thought this was going to be the kind of high watermark. Got beaten within a quarter. Fair enough, it slowed down in the rest of the year, but there's still 50% of growth. And as you can see, obviously most of the money is going into these huge M&A deals, as the panel just said, probably slightly too much. But most of the volume of deals is the thing that's really important here. There was more deals in the year. It wasn't just more money spent, there was more deals. There's 1,320 deals. The grey stuff is basically investments. So investments into new startup companies, investments to growing companies. It has been slowing down across the year. There's a couple of data here. You can see on the far left, you can see that the value of those M&As dropped down, and the private placement was a little bit lower this year as well. And also, it's really important to note when you look at the big numbers that this is impacted by some absolute mega deals. We had almost $90 billion worth of deals in the last year with Xbox buying Activision, Take-Two buying Zynga, IronSource and Unity merging, and PlayStation buying Bungie. And there have been many more. The billion-dollar acquisitions of the ad space. MoPub was acquired by AppLovin. Esports acquired by ESL acquired by Savvy. Embrace has been, and Stillfront have been acquiring stuff for fun. And here you can see, here are those deals. All this data has come from a report from Drakestar Partners. If you're fascinated by the market and the trends, you can go to Drakestar Partners, you can download it yourself. They do come and speak at a lot of our events. They couldn't make this one, but they allowed me to use the data. So this is quite interesting. You can kind of see where the money was spent. This is in 2022, so it's past performance is not a guarantee of the future, right? But you can see what's spent here, and you can see where it's been kind of spent, and the different areas it's been spent in. And you can also, there's 324 M&A deals. You can see the valuations, the kind of variables, the multiples of EBITDA, basically the profit or revenue numbers there. And the variance. It's just useful. If you're thinking, again, as we heard earlier, these terms are going to be getting tighter now, but it just gives you an indication. This private placements basically means investments. So this is money going into companies. Now, obviously, because these are big numbers, 2 billion down to 75 million, these aren't startup investments typically, but you can see where the money's gone and who's invested. This was last year. And you can also see where it's going. As you'd expect, most deals are early-stage deals. That's seed money. That's maybe Series A or pre-seed. 752 of the deals, there was 938 investments made in the game space last year. 752 are early stage, and then you get less and less as you get further along, as the companies need more money and thrive. But obviously, what then happens is the most money goes into those companies. So later deals are bigger. Hardly surprising. But again, it's quite interesting data. You can see where the money's being invested as well. And it is interesting that mobile is not typically, despite mobile being half the industry, it's not the space where a lot of the money's going. Web3, we're in Dubai. Web3 is very big here. Web3 is a big trend generally. This is a map of investments in last year. John Jordan, in his talk, he's got his own version of this, which is very good as well. You should check out that. But you can see here where the big investments were being made. And as you can see, that had a boom in 21, 22, and has then kind of softened quite a lot as well from there. I'm sorry, I've broken that. And this is really, I've broken my graphics bar, I'm sorry. This is really interesting data if you are raising money or trying to sell something. These are the VCs that are investing money. So these are the people that have invested cash. And you've got the early to late, those are the bigger deals, obviously. And then on this side, if you're looking for startup capital, these are the kind of VC companies, the small companies, these companies that are putting in money into companies. These are the people you want to talk to. This is how many deals they've done. You've got Shima Capital and Play Ventures, companies you probably already know. It's just great, if you're looking to raise money, it's good to know who you want to raise it from. And these, you can see where they've spent before. It doesn't guarantee they're going to spend more money, but it's a good indicator. And then this is the same kind of version from the NFT side, from the top investors. Animoca Brands, huge unicorn in the space. This is where they've obviously the biggest money has, but it's Andreessen Horowitz who've spent the most money. FTX obviously did spend a lot of money. They're not going to be appearing in that chart next year, sadly, but apologies to anybody that had investments from them or in them. And again, here's also from strategic buyers. Unless you've got a big company, this probably isn't that interesting to you, but it is just useful to see who's spending money and where. This is the big spends in 2022. And these are the companies that Andreessen Horowitz, that Drake Star Partners are projecting will spend money in the year ahead. So it's very similar, not identical, it's a very similar company. But you can see these are the guys who they're expecting to spend money. Embracer is probably going to be spending slightly less than when this was kind of forecast again. They've had a bit of a wobble as well. But largely those are the boys that they expect to invest. Public markets. Now, it's always interesting to monitor this. It's important. We can't, there's limit you can do to control it, but obviously when companies' valuations get squeezed in the public markets, that means they've got less appetite and less money to invest elsewhere, and everybody gets a bit panicky about the space. It was a bad year for games and a lot of tech last year. You can see that only goes down to September. I didn't put an updated graphic in. It didn't get better after September. It was a bad year overall for most games companies. But this is the first quarter of this year, and you can see, on the public market perspective, things have turned around quite nicely. Their overall index of all these companies is up 12%. Some have massively outperformed, like the AppLovin and Playtika and Sega. But generally, in the first quarter of this year, the games industry shares have done quite well, as have a lot of other tech companies, but games have bounced back well. And that's important because that leads these investors to go, right, okay, it leads them to have more money to spend, and it leads investors to be more bullish about the space. And they were pretty bullish, those investors. So even though Q1 started out relatively slowly, this is the data from Q1 of 2023 in terms of the volume of deals, and you can see you can see again it was very similar kind of overall valuation to Q4. There wasn't as much going on. It has been picking up speed. We've obviously had the Savvy Games acquiring Scopely. We've got the Sega and Rovio big deal going through. Generally, there's a feeling there's more investment activity happening. Obviously, as I said at the start, prepare for turbulence. Fasten those seatbelts. There will be bumps in the road. Embracer, had a very nasty bump in the last few weeks. There was a deal that fell through. Their Q4 wasn't as what they wanted, and suddenly they've had to sort of rethink things a little bit. But that's going to happen. That's what happens when there's a bit of a shakeout. Keep calm, don't panic, whether you're investing or being invested in. And this is the prediction again, based on that, the growth, and generally also what we've heard here, the better valuations, or what people see as the investors would see. Obviously, they wouldn't pay less, as fairer kind of valuations. That actually, Drake Star are projecting renewed appetite into M&A activity. So we'll see a lot more activity of investments. And again, this is the same version of those tables before for people that are investing right now. So there's the VCs on the left, Bitcraft, Andreessen Horowitz, Play Ventures, Griffin Gaming Ventures, Convoy, Makers Fund, et cetera, et cetera. Those are the guys that have been doing the big deals. And these are the guys that are doing the smaller deals, like the Mackay, Big Brain Holdings, One Up Partners, Seymour Capital. These are the guys, if you're looking to raise big money or smaller money, these are the guys you need to have on your Rolodex, you need to be chasing. And again, those are the kind of announced deals kind of so far in the first quarter. Again, just reiterating what I said before, this isn't a global thing that's happening elsewhere in the world. This is a thing that's happening here, and I think will continue to happen here at an accelerating pace. We're not the only people in this room that have seen those figures saying MENA's the fastest growing. We aren't the only people seeing Savvy Games having $38 billion to spend. Everyone in the world is watching this. I actually ran an interesting anecdote here. We ran an event in Riyadh last for a leadership summit in Riyadh for about 120 CEOs last year in end of November. And it was like a new thing, so we were trying to convince people to come and what was interesting. And we had good take-up, but not incredible. Then there was the drop of we've got $38 billion to spend. Next day, we had quite a lot of tickets sold. People are watching this space. They will be coming here, and they are coming here to this show. So I want to also kind of sum up and conclude with a little bit of what I hear. Like I said, I'm not an investor, but these are things I'm hearing. These are things that were said before, but just to kind of cap up. Like, deal flow is still happening. Some of the big deals, as we said before, started earlier. Those deals typically take 6 months to a year to go. So seeing these big numbers isn't always an indication of the market now, but it all helps. Capital flows definitely haven't stopped. People are keen to invest. Things have slowed a little bit. There has definitely been a clampdown on mobile investments due to the IDFA and uncertainty. But again, as we saw here on the panel, if you weren't here before, the panel was still relatively bullish on mobile. They were more selective, but mobile money, the most money in the market is still being made in mobile. I don't expect that to change anytime soon. Web3 is having a tougher time. These are actually quotes or statements by the people. Traction is becoming more important, of course. The idea you can just put Web3 on a deck and raise like $10 million is no longer here. You might be able to put AI on a deck and raise $10 million, but I suspect that will be hard as well. It is a buyer's market. And they're saying that for startups, they want to see traction, and they also want to see that there's a real plan. It's less about a deck these days. It's all pretty sensible stuff. It's how investment should be, really, but it hasn't been how investment has necessarily been for the last 2 years, hence maybe those big numbers. And this is something somebody said to me yesterday, actually, but I won't say who it was. But yeah, basically, there's a thing that actually there's still a lot of hunger for startup investment. Maybe second stage, third stage investment, people can be much more tight on the terms or much less willing to make a further bet if the fundamentals aren't right. Here's some of the key trends. I'm just wrapping up. 2022, massive growth. 23, more cautious in a buyer's market, but it's still happening. There will be more mega deals. There's going to be some big deals happening this year. Watch out for them. Some we won't even thought of yet. The consolidation phase is by no means over. It's definitely a slowdown, but there's no stop to the investment cycle. There's plenty more there. Mobile may be a bit more cautious, but again, as we've heard from a lot of people are still investing. And Web3 is certainly going to have a tough time. And again, these are the league tables of people that spent money last year. So is it still a good time to invest or raise? Well, it seemed like it's a good time for investors. There's a lot of hunger there. People were identifying that this is a great time for investors because the terms are a little bit more realistic. So I think, yes, the games industry prospects, Upbeat is almost doing it down. I think the games industry, if you take a 3 or 5 year or 10-year kind of time frame, which is what you have to when you're building a company, it's going to be incredible. The upside, there'll be whole new things I haven't even thought of that are going to drive revenue. But games is only going upwards. I did a trends presentation yesterday that talked about the engagement now, but also engagement in the next generation. I love games. My son is more engaged in games than I am, and it's only going more that way. He spends all his time with his friends via FIFA or Minecraft or something like Fortnite or whatever. There's a lot of money out there. If you're trying to raise money, there's a lot of cash sat on the sidelines. These funds have raised money, as Paul explained before, they have to spend it within a time frame. So there is money out there waiting. There's a lot of angel money out there waiting. I'm in a couple of angel groups. And there's still hunger. There's still a lot of looking at decks. There's still a lot of deals being done. I think the seed level, I don't even know if the seed level's changed that much, to be honest, despite what's going on in the market, from what I've seen in the game. So if you're raising startup capital, you might have to accept slightly different terms, but there's definitely money for that. There will be more scrutiny on fundamentals, on the business case, on your team, on your vision. Later raises will be much harder. Later raises are the thing that's going to be much harder now. They're really going to want to know that you've got traction along your game plan. If you haven't, you're going to have to rethink. You might have to take a down round. You might just have to sort of like, hold it out for another sort of 6 months or so. And the process will definitely be slower. That's definitely true. So here's some advice for what it's worth from an occasional angel. I think it's really important to ask before you go into fundraising if you really need and you really want to raise money. It's not easy. It's a journey. It's not like, oh, I go to the bank, I've got a loan, I'm off. Even that's quite hard these days. But you're committing to a job almost. It's a full-time gig for someone for a while to get that money. You've got a lot of work ahead of you. Is your project investment worthy? That sounds pretty stupid, but actually, are you really sure that what you're pushing out there to the world makes sense to someone else, feels like something that can return their money? We heard from the Game Fund that when they look at deals, they want to think there's a potential that every single deal could potentially return their entire fund. Let's say they make like 20 deals from a fund. So, they want a 10 to 20x. That's what VCs typically want. Investors want a return, so they want to know where it's going to come from. How much do you need now and in the future? It's a common mistake that's made in investment, and I've done it as well. I mean, I've never raised that much money, to be honest, but is budgeting in a way that's, tight budgeting and not really thinking about things that could go wrong. Games projects are always late. They always take longer, they're always more expensive. There's always things, bumps in the road. So you need to have a realistic runway. You need to have enough money for staff, not just at subsistence levels. You need to really think how much you need. You might not get all that, but you need to be realistic and a bit conservative to start with. Get as much free help as you can. I don't know enough yet about all the government support here. I know there's all sorts of different initiatives and different SAPs and from the free zones and whatever, but in the UK, in the US, and Canada, and all over the world, there's usually some local support for startups of one kind or another. Pitch deck is it's your front page of your newspaper. It's you. You've got to make that pitch deck has got to be succinct and it's got to be amazing. And the only way you're going to do that is to show people. It doesn't have to be investors. It can be your friends. It can be other companies that you trust. Keep showing people. Take feedback. Edit. Repeat. And keep doing it. Network, network, network. The fact you're here, if you're trying to raise money, is brilliant. You've got to be out there. You can't expect people to come to you. And you can never have too many friends if you're raising money, or generally, I think. But do understand, like I said at the start, this is a job. It's a job in itself. You're asking people to commit money to you. The people that you will want to ask a lot of questions. You're going to have to see a lot of people. You're going to get a lot of no's, I'll say in a minute. And even after you've got the money, you're going to have to manage those investors. You're going to have to report back to them and tell them how it's going. Not every day, but they're going to want to know what's happening. And you will get a lot of no. Be prepared that the majority of the people you're trying to raise money from will say no or not even come back to you. But you just need to be resilient and not give up. So I don't know if that's useful, but that's my thing. I think the most useful thing you can do if you're interested in the economics and the market trends generally is to download this. Go straight start, download this. There's loads of other great sources as well. Newzoo do some great analytics. DDM do some great stuff. I trust those guys. There's a few that emerge above the rest. You get kind of a lot of reports will say, yeah, the industry worth $10 trillion, and you find that half of their other reports are about ironing or shopping or something, and it's like, well, you don't really know the industry, do you? But these are guys from the industry. They know the industry. So yes, check that. So I think that's me. I think I've hideously overrun, Dave.